So today we're talking about Wise, previously known as TransferWise. We're going to look at the full year 2024 results in detail, and then we're going to analyze whether they're an investable business, their growth prospects, and just look at them in general. None of this is financial advice. I'm not a financial advisor, but I do use financial logic to give my opinion. I hope you enjoy. So Money Without Borders, they started as an FX business, financial exchange, allowing people to send money with minimum kind of fees. I think they started with 0 fees. They do charge fees, but they're less than banks, as we'll see. So it's a large addressable market. They're a tech business. Really, they're a fintech business. People do love the business, and it's now profitable. They sent £2 trillion. The market size is 2 trillion plus by B2C, and then SMBs and businesses send 9 trillion. So they have less than 5% of the market share at the moment, it looks like. They send money. They also offer international banking, and there's some technology. And the results are pretty impressive. So the active customers has gone from 7 million to 12 million in 2 years. That's close to double, not quite double, but still it's up a lot. I don't know what that is, maybe 70, 80%, something like that. The volume in billions has gone from 76 to 118. The customer holdings have also gone up as well. So assets under custody. I liked this actually when I saw it. It explains it. So the investment choices. They invest in marketing, which gets them more customers, more volume and scale, more gross profit. That allows them to invest in product, tech, and infrastructure. More products and features means a better UX, a better CX, a better customer experience. Then they're able to allow lower prices, which again improves customer experience, leading to more volume and scale, leading to more gross profit that they reinvest in product marketing and lower prices. And it's a nice virtuous circle. So that makes sense. I mean, I've known about Wise or TransferWise since about 2015 or 16, I can't remember. When they just launched, I was working in the FX industry, and I could see how fast they were growing. And I thought they were a good business then. I haven't invested in them, so I'm just doing this from an outsider's perspective, but I am interested in this. So let's look at it. Underlying income has gone up 41% in the 3-year average. Profit is up 83%, and reported profit before tax is up 127. I've got the accounts up here, and you can see it a bit clearer in the accounts as well. You can see how much underlying income has gone up, 400 to nearly 1.2 billion. So it's nearly tripled in this 4-year period. And gross profit is up nearly 5x. Profit before tax is up nearly 10x. Underlying profit before tax is up a lot as well. Earnings per share are up 10x in 4 years. That's pretty substantial. Let's go back to the slides. So they're building the network. So they actually allow other banks to provide FX services. So the technology platform of choice, it looks like. So they're using Swift, but they're becoming the kind of payment platform of choice for people, which is interesting. That obviously gets them, a lot more volume. So basically, they've become like a fintech for fintechs and a fintech for banks. They've got a lot big engineering team, a single global treasury system. They've got good customer service, machine learning, and AI, and they've got a big compliance team as well. They localize their products. They have lower costs because of their volume. They have 24/7 customer service, and they've got this compliance stuff, and they have below average fraud because of the hundreds and hundreds of staff they have in that department. So they have faster payments, as you can see, way faster than banks, and they're cheaper than banks as well. Bank beating rates is something they used to say many years ago. I don't know if they still use that. So they offer a digital account, a card, and a platform. I guess the platform is more for the businesses. They now offer stocks, and they're offering bigger size offerings to different markets, so they're expanding their capabilities. So assets are now available to businesses. So I guess what businesses can buy stocks, I guess. And these are the partners they work with. So they work with some pretty big partners. They've got Monzo in the UK, N26, Shinhan Bank, Google Pay, Stanford, IB, Interactive Brokers. These are big people. And, it's interesting because as all of these partners grow, almost by default, Wise is going to grow as well. So that's interesting. They get a lot of volume through, even if they're just the partner, as it were. But they are growing their own customers as well. They've always been very good at marketing. 2/3, 66% of customers join through a recommendation. That's really product growth, really, because that's what people love, the product, so they scream about it and tell their friends and family. And you can just see, this is what it looks like. And they have low attrition, which is really true across most fintechs. You don't leave a fintech, really. You're more likely to tell someone about it than leave. And that's what it's suggesting in these charts as well. So more customers, and and they stay longer. But what's interesting is the volume here. A lot of fintechs, most fintechs don't cross that 10 million mark. So TransferWise, or Wise rather, passed 12 million this year. So that's very impressive. Assets have grown as well, and in all territories and all countries and territories, they're growing in numbers. So it's across the board. Obviously, volumes are going up as well. Businesses seem to be more interested than personal, which is probably higher return on ad spend when they're marketing. They probably have a higher return marketing to businesses than to individuals. Assets under custody, I assume that's when people hold money in their bank account, or if they hold stocks possibly in their account. Again, balances, I assume that was for people that are needing to transfer money. They might leave a balance on their card or in their account. But either way, it's pretty good. Over 13 billion in balances and 2.9 in assets. So that's pretty huge. A lot of fintechs are very proud to have more than 1 billion at the time of recording, at least. So that's very strong. They're saying it's expensive for banks. They're obviously the cheaper option. So I have a lot of active customers. Cards, 17%. From my time working at NatWest, cards are a loss leader in many cases, but in international transfers and international spending, you can take fees. But a traditional debit card, even credit cards, banks don't really make money on, typically. These are the card and other revenues. Remember, when you read card, it's likely to be fees, FX transfer fees and whatnot. Even if they're cheaper than banks, they're still making money from it. What this means is that businesses brought more money than people that just use cards. Transfer only customers are card users, just transferring. Card and also account, I'm sure they can do it through the account and the app as well. But businesses buy assets, I assume, as well. Wise account customers bring more underlying income, so they're going to go after businesses. And they're investing and they're profitable. Actual income growth of 46%. It's pretty good. So I think it's heading in the right direction, to be honest. 30% increase in active customers, which means they're doubling every 2.5 years. So they may even get to something like 25 million active customers 2 to 3 years from now. And likewise with volume, that's likely to double in 2.5 years. Customer balances will double at this rate in just over a year and 3 months, something like that. Underlying income looks like about just under 2 years, and with an 83% increase in profit. It's quite harder to predict because it doesn't look like it's a derivative of income, but I don't know if that's a constant. or if it changes every year. But I wouldn't be surprised if underlying income goes up 40%. It's hard to estimate, but I wouldn't be surprised if profit before tax goes above 300, probably above 400, maybe above 500 in the next year or so. So that's pretty sizable business. Yeah. So underlying income grew 31%. So yeah, it looks like it's doubling every 2 years. 2022 was 550, sorry, and then 1,170 2 years later. So it's doubling every 2 years, something like that. So that's very good. They started in the UK. That was the first market, as I remember telling you. I was competing with TransferWise, or that's what they used to be called. Now they're called Wise. Cost of sales is going up marginally, 2% increase. That's the feature of software as a service or fintech. As you scale, cost of sales doesn't really increase that much, but profits do. As you can see here, underlying gross profit in 2021 was 250 million. It's now 850 million. So even though it's a sizable business, valued about 7 billion, it's still growing pretty quickly. And the margins are going up as well, from 62 to 73 gross margin percent those. So they invest in marketing, and so they should really. Product servicing, I guess that's customer service, etc., and other functions, risk management, and others. Okay, fine. So the underlying adjusted EBITDA margin is nearly 30% this year, and that's a big increase. Although it looks like the average is probably around 20 to 25%, which is pretty good. And the underlying profit before tax margin is increasing as well, which I assume that means because they're taking more businesses in and people that are investing in stocks and having assets, etc., they're probably more profitable regarding that compared to card transfers, which is probably low margin. Everything's going in the right direction. Look at the earnings per share up 10x in 4 years. That's wildly impressive. If they were to do the same thing again in 4 years, the EPS would be 340. I believe the share price is about in the 700s or 800s. You can have a quick look. At the time of filming, at least 700. So it'd mean in 4 years you'd have a PE of 2. Anyway, I digress. Free cash flow, pretty high. Free cash conversion, also pretty high. So this is the thing, really. This is the key. Lower prices, better CX experience, customer experience, increasing marketing, more features, more customers. Bang on. Strong product, new features. This Wise account, like they're expanding, basically land and expand. They've gone from cards to investments and to business, B2B. 20% underlying income growth expected in year 2025. However, they're probably going to overachieve on that. Key drivers, customer growth. So yeah, this is what I was saying before, like customers have doubled in this 4-year period. Same with the volumes, card revenue, customer holdings is up by 4x, and underlying income is up, as a blend between all of these 2.8, and that's probably more in the last year. So the trend is getting very, very, very strong. And I've shown you this before. So I guess they're just repeating it to slam it home, really, that more marketing and more CX, more products, low prices, blah, blah, blah. Okay, fine. So that's that. I'm just going to switch it over and see if there's anything else interesting. I do like this in the annual report. I really like this layout. I think it's easier to read personally. And, profit before tax up 10x, earnings per share up 10x. So this is really impressive stuff. And, if they do get to 25 million customers and there's a larger share of businesses from that, I wouldn't be surprised if earnings doubled pretty soon, 2 to 3 years from now. I'm not a financial advisor. I'm just using financial logic here, just my opinion. But if we go back to the share price and let's say earnings per share went to 75p in 2 years, you're getting this at about a future earnings of like P of 8. It's still, like, I'd say it's not the cheapest stock out there at a P ratio of 20, but then it's growing much faster than that. If we think about, from a 10x growth in 4 years, I mean, even from 2022, it hasn't been much growth. So it's actually 10x in 3 years. That's enormous. That's like more than doubling every year. So that's an insane growth rate. And that's on earnings. On customers, I can't see customers, but anyway, they've really grown. I think it was from 6 to 12 in the last year or so on the customer side, like volume of customers. So they're really doing the right thing. There were 6 to 12 over that 4-year period. Anywho, it's expensive. It's valued at 7 billion. It's got a P ratio of 20, but it's basically almost doubling like every year or two, like earnings per share. So like that's enormous. If the EPS does double in a year, then it'd go down to a P of 10. If it doubles again, it'd go down to a P of 5. If it doubles again, 2.5, and doubles again, you're at a P of 1 within kind of 5 to 10 years. So I do think it's expensive. It's been lower than this. I mean, a couple of years ago it was 300, but remember a couple of years ago it was it had only earnings of 3p. So the earnings were 3p, but it was valued at £1,000, £10. So it was incredibly overvalued. Then it went down in price. And I think it's probably more reasonably priced at kind of 500 pence if we look at the situation right now in terms of earnings. However, they're kind of, I think analysts and the market is kind of pricing in a lot of this growth. In terms of the year count, like the lowest was 634. So yeah, honestly, I really rate TransferWise. Unlike Revolut, which has really struggled to make money, TransferWise has cracked it quite well. I think that I've really appreciated TransferWise, since I knew it was called TransferWise and I was competing with it in the FX world, 10 years ago. And even their products, you look at their website, it's still an awesome website. They've got videos, they've got like animations I was seeing, you can see here. And it's just not many websites are as good at this in the fintech space anyway. If you go on a lot of fintech websites, they've always been, look at this, it's just quite cool. It's just quite cool. And then you hear about the offering and the low rates. They're going to have an incredibly high conversion rate, which means, of course, they're going to have low churn, and it's going to be cheap to acquire people, and people are going to tell their friends. So yeah, I think it's a business to like. Is it an immediate buy? Not sure, really. Depends on your outlook, on your approach to investing. I'm not a financial advisor, of course, but in my opinion, there are some people out there that will pay a PE of 20 or 30 for a high growth company like this. And then you have other value investors who probably wouldn't touch this. They would say it's a bit too much. There isn't real clarity on what could happen. I work in marketing, so for me, I can see that they could easily get to 25 million customers in a year or two. Maybe it might take 3 years, but I think it will probably take 2. And I think earnings per share will probably double in 2 to 3 years or less. So you're actually getting a forward PE of 10. But also you have to, I suppose the risk with this kind of thing is, you have to be willing to take a haircut in the valuation. If you buy it now and it does go down, then you have to be willing to take maybe a 50% reduction in your investment. Conversely, if you don't invest now, if one doesn't invest now, I'm not saying what you should be doing, but hypothetically, if one doesn't invest now and earnings do double in a year or 2 years, then it becomes very cheap and the price will skyrocket. It could easily double from here. So if you think about it, in asymmetric risk return or risk reward ratio, I think it's far more likely to double in the next 2 to 3 years through the earnings going through the roof than it is to drop by 50%. Having said that, no one controls the market. and financial logic is often not used. Fear and greed are the main kind of catalysts, both up and down, for share prices. And even Monish Pobrai, one of the most successful investors of all time, says things like, old too soon, wise too late. Whenever he buys a stock, it always goes down for the first year, and that often happens to me as well. Doesn't always, but I like Wise. It sits in an interesting space. Fintech, I like fintech. Most fintechs are privately held, and sometimes you can invest in them through angel investments, which I've done. I've invested in Moneybox, in Chip, in Plum, in Wirex, and a few fintechs and a few more. And this is publicly listed and has 12 million customers and partners with really interesting companies. So I really think it is a company to watch. They're going to release some earnings, I think, later on this month. I think one of the first quarter of their next financial year. So I'll analyze that and we'll see where they're at. I hope you've enjoyed this video. Remember that knowledge is power, and progress, especially the right kind of knowledge, and progress is everything. If you have any thoughts, comments, queries, ideas, just pop them in the comments, and hope you've enjoyed this video. If you know anyone that wants to learn more about investing, angel investing, I'm not a financial advisor, but I have been doing this for a number of years as a hobby and as something to kind of, I suppose, get on in life. One of the ways to, one of the easiest ways to get on in life is to think about investing. So I hope you've enjoyed this video, and obviously to start investing. I hope you've enjoyed this video. Make sure to subscribe, and I'll see you in the next upcoming video, which should be popping up around your screen now. Take care.